everyone. My name is T, and I'm on the Vancouver Startup Week team. Before we start, I would like to take a moment to acknowledge that we are grateful to be virtually gathered on Indigenous land, regardless of where you are joining us from. I'm grateful to be on the traditional, ancestral, and unceded territory of the Musqueam, Tsleil-Waututh, and Squamish peoples. I'm privileged to live, work, and play on these lands. First, I'd like to thank you for joining us for VSW 2021, and welcome to Fireside Chat with Dave Parker, Startup Ideation to Product Market Fit, hosted by Startup Grind Richmond. The session is also part of the VSW Founder Track and is proudly supported by Sage Accounting. Sage knows you didn't start your business to become an accountant. Sorry to any accountants out there, but Sage Accounting keeps your business organized, running smoothly, track your cash flow, send out invoices, and get paid quickly. So you can visit the Sage Accounting booth to access free guides and templates for starting your business finances the right way. Plus, you can get an exclusive VSW discount if you're ready to switch from Excel. So during the session, if you have any questions for our speakers, please post them in the Q&A in the Whova session. You can also upvote questions from other attendees, but I'll now pass the mic over to Kenneth and we'll begin.
Okay, thank you very much. And welcome everyone. Thank you for joining us in our Startup Grind Richmond section. And thank you, Dave, for coming. I'll give a brief introduction on what Startup Grind is for people that haven't heard about us or the first time coming to a Startup Grind chapter section. So Startup Grind is a entrepreneurship community that started in Silicon Valley 11 years ago now. We host monthly event where we invite successful entrepreneurs and startup leaders to share their startup journeys, to share their knowledge so that more people that are building startups or looking to build startups, they can learn from those experiences. And hopefully we can also inspire more startup founders to build startups. And we're lucky to have Dave today. And thank you, Dave, for coming and to share your startup journey and also your knowledge and experience with us.
Happy to be here. I'm a big Startup Grind fan, by the way. Derek Anderson's a good friend, and Mike Grabham runs Startup Grind here in Seattle. And well, I've known Derek for a long time, since we were back at the Startup Weekend days and kicking off Startup Week, believe it or not, all those years ago.
That's great. Let's give the audience a brief, introduction on what we've done in the past. I know you've done a lot, with Startup Week, and also the program that I'm running, Startup Boost Vancouver P-Accelerate program, is also started by a Startup Next program, which is also you're part of that.
Been involved in a lot, yeah. So so founder journey wise, 5 startups, sold 3, closed 2. My day job today is I help founders land the sale and transaction when they go for M&A, is kind of the process. So we do sell side M&A work for companies mostly on the West Coast, a little bit in Canada, as well as Seattle and some in Colorado here lately. So my day job today is not as a founder, but helping founders actually exit. Of the 5 companies, selling 3, closing 2, gave you some experience in both successes and failures, both. And then at one point I had the chance to join Up Global, which was the merger of Startup Weekend and Startup America. So the 4 big products we had there were Startup Digest, which there's a big following, Startup Digest Vancouver. Startup Weekend, my last full year there, we did 1,265 events worldwide in 120 countries and about 460 cities with 74,000 attendees. So that was kind of crazy. Yeah. And then we launched Startup Week globally. So it originally started in Boulder with Andrew Hyde, who's the same guy who started Startup Weekend, by the way. It's from a founder perspective. Andrew's a great guy and a friend. And the last one was Startup Next, which became Startup Boost. So the whole ecosystem play of like, how do we help founders from kind of the pickup basketball game that's Startup Weekend through actually getting launched, which is Startup Boost, has been part of what we got a chance to be a part of. So when I joined the organization, we were doing about 550, 600 events a year. Mm-hmm. And when I left, we were doing over 1,200 events a year. So we sold the company to Techstars in 2015. And I went on to go be a CEO again of another startup. And then recently published a book called Trajectory Startup, which is Ideation to Product Market Fit. And it's filling that gap, Kenneth, between like Startup Weekend, Kenneth and I met each other, we're gonna be co-founders, we're gonna leave our day jobs. And I'm like, whoa, like before you leave your day job, there are some things you can know. And the book really covers that kind of post-inspiration, pre-leaving your day job part of the founder journey.
Yeah, I think that is great. I was just judging in the Hack for Health hackathon that is part of the Startup Weekend Vancouver Startup Week, and you know it's quite amazing that there's a lot of people trying to start you know a startup after they finish a hackathon because they find a team that is want to do something similar, and they can work on something and they start something they want to finish too, right? So
Right.
it is how do we help them and support them to get from just a project, right, a weekend project, to like something that can be more with more research and more customer discovery and more polish to it. They can start to form a initial startup, right? And I think
Right.
this is
And can
awesome.
it make money? I mean, the math, as you know, about startups, and I'm sure everybody who's sitting in knows as well, right? The statistics say 70 to 90%, depending on which statistic you believe, of startups fail. And it's not because of lack of effort for the most part, or enthusiasm or passion. Passion's critical, but not sufficient. Like, you really need to ask some questions about, like, can this company make money? And I know that's contrary to what most graduation speeches are today, which is like, it's important that you follow your passion. And those speeches are usually somebody who's already made all of their money and is now following their passion. But I don't, as it relates to a startup, it's not actually great advice. Like, you should follow your passion and know how it's going to make money.
Yeah,
So,
exactly. I think that's important, especially with a lot of different programs now that we can support the early stage of startups when they have an idea, and then they can form to begin the process of actually building their startup. Building a startup is like discovering if this is something that is going to become a business, a real business, right? So
right, for
that
sure.
is very, very important. I think with your book, you mentioned from ideation to a traction in like 6 months, right? In a period of time. Like,
Right.
what are the different process or different stages of a startup that will need to go through in those initial 6 months, for example? We
Right.
just give like a big overall big picture, and then we'll dive deeper into each
Sure.
different stages
Yeah.
so
So
we can help them.
Totally. And the book actually breaks down segments of, like, here's 28 deliverables you need to deliver in these 4 months. So the first couple months of the way we've broken it down into the 6 month program is like, here's a framework for how you think about ideas. What makes a good idea? So, so we break down the 11 frameworks of startup ideas. So, give you an example of that. One is the Zillow founder talks about power to the people, right? So Rich Barton founded Expedia within Microsoft, and then Zillow as well. And the thing that he was a big fan of, Kenneth, was like, how do we take opaque data sets and make them accessible to the consumer? And one of the things I saw when I was at Startup Weekend, I was doing an event in Rio de Janeiro, which was amazing, and people are amazing. And usually at a Startup Weekend event, you'd have 2 out of maybe 10 of the companies be a marketplace, right? And in Rio, there was like 6 of 10. And I was like, this is super crazy. Like, why is that number so different? And so I spent the weekend kind of asking people questions. And one of the consistent themes was there was a bunch of opaque data sets that these founders were trying to make accessible to founders,
Hmm.
which is very much aligned around Rich's thesis around power to the people.
Hmm.
So I break down 11 of those frameworks, and they're not designed to be all inclusive or the only way you can think about a startup idea by any means, but they are ways to think about the idea, right? And so one of the other examples is what I call the waterline view of it, right? There's a bunch of problems, and some of the problems are below the waterline, and you can't make any money there. So you
Hmm.
have to focus on the problems that are above the waterline, so you can reinvest in the ones that are below to really make a platform work and build competitive advantage. So that's kind of the starting point, is what makes a good idea. And then I need to go get out of the building, as you
Hmm.
will know, and do
Yeah.
customer development and actually ask questions of customers, or my particular, what we call ICP, the ideal customer profile, and really interview them and say, is this a problem for you or not? And, I know some founders will say, well, if Henry Ford said, if I asked my customers what they wanted, they would have said a faster horse. So, and as a point of reference, my grandfather owned the first Ford garage in 1911 in Camas, Washington. And I will tell you that in 1911, there was no such thing as the internet or access to information. So that was true in Henry Ford's day. And you could have it any color you wanted as long as it was black. because they'd ship the parts out to these hubs like my grandfather's, and they would assemble them there. So it wasn't like you could custom order your Model T using the form online from Ford.com.
Okay.
So
No
what makes a good idea
customization.
matters.
Yeah.
So yeah, so that's kind of the starting point. So we give them a couple months to go validate that idea, go do 25 or 50 customer development interviews, and really ask customers the question of like, what are you doing today? And to give you an idea on that kind of thing, one of the things I love about this is when you go out and talk to customers, one of the things I love to find out is, do you have a hack for this problem today? Like, is it really a problem? And then what do you do to solve it today? And when the customer's like, oh, we've created a Slack channel and a script that runs on Excel, and I'm like, oh, I really love this problem, because if the problem is big enough that they've created their own hack to do it, then there's probably an opportunity to build a product there. If you talk to them and the answer is like, it's not really a problem, right? And then the answer is, you, as a founder, you can't manufacture a problem, right? You actually have to go find a problem first. So that's one of the starting points from the ideation stage. Then we start walking you through like, okay, now that you've got some initial feedback, what kind of product do you want to build? So how do you scope the product? How do you understand the features? How do you build a scope document? So one of the hacks I love about what we put together with this was I can build a lightweight scope, and I can then take that scope document to Upwork, and I can post a job and bring in 3 or 4 vendors for a 1-hour conference call, right? So I'm gonna post the scope document. I'm going to ask them to sit in for a 1-hour meeting. I'm going to ask them to document the meeting notes. And with that informed decision, so they get to ask me questions, then they actually get to give me a proposal on a limited scope of work, which would be a 2-week sprint. So what I'm looking for is a partner, especially for non-technical founders. So you're like, I want to found a technical co-founder. You can probably build an MVP for $1,000 or less, depending on how well you scope it. So I then will get 3 or 4 proposals. I'll see who's good at communicating. I'll see who understood and wrote good questions. Were they on time? Were they articulate? Can I, because a lot of offshore ones are like, maybe challenging communicating sometimes. So now I have somebody who can actually build me an MVP, or the first sprint of an MVP. So we walk you through that whole process in a very step-by-step way if you're a non-technical founder, so that you can actually get an MVP back. Now, the challenge there is you're going to throw it away, right? But at least you can show it to customers and something actually works. So that may be a mobile app, it may be a web app. So we're really walking you through that part of the process as part of it. And then understanding how customers, or how actually companies make money. So one of the research projects that came out of this was, somebody asked me when I was at Startup Weekend, hey, can I have your financial model? And I'm like, well, I can give it to you, but you're doing a marketplace, which is B2C, and my financial model is a B2B subscription, and those are just different. So, we started this wacky quest, and it never was intended as a quest, Kenneth. I reached out to the CEO of Crunchbase at the time and said, hey, can you just give me a list of every seed funded company over the last 18 months? Ends up as 2,654 companies. And because I was on and off CEO, it took me a while to get to them. So we ended up doing a 5-year longitudinal study of those companies and breaking down what revenue model, so subscription, metered service, transaction fee, marketplace, and there's 14 revenue models. That's it. So now over this 5-6+ year span, there's been very few changes in the revenue models. So if you remember Groupon, they were the new one at the start of this research project. Now Groupon really is just transaction fees and commerce. And then there were some new ones. There was one new revenue model that came up during that time frame, and it's called metered service. So if you know Twilio or Splunk or UiPath, basically there's a basic transaction subscription fee, and then as you use more services, Auth0 is another example, you charge more, and that's really part of the API economy. And that's a super interesting trend because those companies have super high valuations. So we went back through and looked at all 14 revenue models, and then started to look at the analysis of the models now about which revenue models produce the best results from a return on investment for the founder. And I'll tell you, the numbers are wildly different. Like a services business. So if you and I did a consulting business, and it was $1 million a year business, we would sell it for about $1 million. But if you and I did the same sort of business and maybe in the same market, but different, it was a subscription business, that business would be worth $10 million.
Mm,
So the amount of time it takes for you and I to build a business, it's the same,
mhm,
but our outcome as founders is wildly different. So we walk the founders through the topic of like, should you do this or not? Right? Here's the 14 revenue models. Pick one. Here's the price to build your product, because we've done that with Upwork, right?
mhm,
Here's the price to sell your product, because we talk about your go-to-market strategy and sales and marketing. And what you have left over is gross margin or net profit. And if you can't sell the product for a reasonable price, then you really have to push down your cost to build it. And if you can't push down your cost to build it, you have nothing left over. So when we run the program here in Seattle, about 40% of the people quit after month 4, which is
mhm.
awesome because they can take the tools they've learned and go out and build it again with a better idea. So it's really, I think earlier in my career, Kenneth, coming out of Startup Weekend, I was more pedantic about like, oh, that's really not a good idea. You shouldn't do it. And now I'm like, here's the questions I would ask as a founder if I were you, but you need to go answer them yourself, because if you don't get the answers that are sufficient, then it's better to pivot now than it is to, take a second mortgage and spend your life savings and, auger it into the ground, which I've done that too. That's probably part of the lesson learned in the whole thing.
Yeah, that's good. I imagine also, with the different business models, sometimes a startup they have to figure out which business model might work for their specific problem or situation or their market they are in. We were just talking to one of the mentors with this Startup Boost Vancouver program, this cohort, and she actually changed and pivot in with her startup for like 4 or 5 times in terms of business model before she finds some one that actually work for her case and which is turning into profit and she can scale this. Like, so I think this is also very important to learn in terms of what kind of business model might work, right, for
Totally.
this case.
Yeah, and I always tell people I'm not, if there's a new 16th model, I'm all for it, right? I'm not or 15th model. I'm not limited to the 14. I'll definitely write about it. The one right now I'm trying to figure out is Bitcoin mining.
Mhm,
But it's very much like commerce, right? So I'm manufacturing something that has increasing value. So it's unique enough that we're tracking it separately, but there's, it's a great question. When coins and tokens came out a few years ago, the answer was
mhm,
it wasn't really a revenue model because it didn't have any key metrics you could measure, like conversion rates and lifetime values and CAC ratio, cost to customer acquisition ratios, and that kind of thing. So yeah, so that's what the program walks people through in the book. And I think the big thing is that I encourage founders that if you go a month and if you haven't hit any of the deliverables, I would really double down on like, sometimes that's life, right? Life gets in the way. Kids, things like my wife's a cancer survivor and doing great now. But when we started our first company 20 plus years ago, she was diagnosed with cancer, and life definitely happens, right? So, but if those things aside, if you're not making progress on a monthly basis, it's probably because you know in your heart that the idea is not a great idea. And definitely if you're not making progress 2 months in a row, you should probably pivot to a new idea, that use what you've learned about startups to go pursue an idea that's a bigger idea. And I think, everybody has a desire to be like, I'm going to go build a unicorn. Okay, there's some things about those companies that are common. One of the things is they tend to be new and nascent markets that aren't currently billion-dollar ideas when they started. So like Airbnb wasn't a billion-dollar idea when it started. That market was nascent. Nobody was renting out their rooms. Or Uber, viewed their total addressable market. Their entire market size is 40 billion and growing was their entire market size when they launched, right, in their original pitch deck. So the unicorns definitely have disproportionate favor to markets that are brand new and are nascent. And the challenge there for the founder is when you look at it, you're like, I believe this is a great market, but your investors are going to be like, don't know, that's like super early, right? So you have to have enough runway that the market can actually mature with you. Because if you're too early, right? There was a company in Portland that I know one of the VCs here in Seattle funded that was 10 years before Uber. And the idea was really similar, but smartphones hadn't developed the same way. So sometimes there's external things that need to happen before your idea is, incredible. So I want everybody to be able to have a chance to be a unicorn. There's mathematically, that's about 5%. So of the companies that start every year, about, I think it's 14% get funded. Of those that get funded, 5% become unicorns. So the math is challenging at best. So you want to go in eyes open.
Yeah, I think that's great advice. And also for the startups that are actually been through this early stage, so they did their customer discovery, they figure out the business model that might work for them. What are the next steps after they build the MVP and things like that?
Yeah, well, I think you've got to think then through your go-to-market strategy, right? So there's some things. So what we do in breaking it down is, if you think about a Venn diagram, I have my creating value is my product or service, and it's really my team and the market size, right? So those, who's building my product, what are they building, what are the features, and how much will it cost to build it? So that's the top circle of the Venn. The second circle of the Venn is, how do I deliver value? And delivering value is my revenue model, my marketing, my sales, and my pricing. That's it. Because those are all the levers you can pull. Like, I can choose how I price the product, I can choose how I sell the product, I can choose how I market the product, and I can choose the revenue for the most part. Sometimes the companies choose their own revenue model. So if you're building a marketplace, as an example, it's a transaction fee that occasionally has a subscription tied to it, right? So the posters will pay a subscription as well as a transaction fee. So, but in general, those are the variables that are in your control. And to kind of help everybody understand, like, if you were to build out a financial forecast for your new startup, all of the variables that we just covered, cost of building, cost of selling, marketing, sales, revenue model, and pricing, are all the variables that you're in control of, other than hiring, right? And the hiring, by the way, is an expense, right? So I have to hire in front of revenue to get the engineering done. So the thing that we try to walk the founders through in the book is, how do you think about this from what are the inputs that are in your control? And for technical founders, or for founders who don't have an experience with sales and marketing can kind of be a dark art. And how do you do it? And so we walk them through, how do you build your go-to-market plan? And the concept there is like, what are my marketing channels? How do I track them? Right. And I don't think it's rocket science, but if you've never done it before, what happens is, a lot of times the founders will be like, oh, that's in my business model. Like, there's some sort of magical box over there that has all these things in it that I'll figure out later. I just want you to figure out earlier, because if you know that, you can make a decision about, like, oh, where I'm going to spend marketing dollars. Oh, how am I going to hire a sales team? There's this concept, as you know well, in the startup world, called zombie startups. And one of those things that those companies have together is, they build a product that their customers like, and they probably raise some money, but they never have a breakout, which means they can't raise the next round of funding. And because they've raised some money, they don't want to quit, right? Because it's failure. The challenge is, they never really scale past the CEO as the salesperson. So consequently, you end up with a zombie startup, which to me is the most tragic location for startups to end up, right? As an investor now, I look at it and go, like, if you took money from me as an investment, and you tried and was smart about how you went about it, but you failed, it happens. Like, that's the math, right? Versus if you never got past the scale point and never scaled past you as the salesperson, that one's really tough, because you kind of you've got a short window to go really ramp stuff up. And so trying to help those founders not make those decisions as well is definitely part of the book.
That's good. Now, you mentioned one important thing is that the startup is not scaled because the CEO seems, or the founder, or whoever is taking the sales or marketing or revenue, seems to be the bottleneck, right?
Right.
They're not getting more and cannot scale from that. What will be the advice for this type of situation? How do they get through that bump? Right, so that they can see more progress, so that they can move to the next level, so to speak.
Yeah, I mean, you're really creating a scalable process, right? So there's a bit of an existential. It has to be past you, right? Or just Dave's network or Kenneth's network that we're selling to.
Mm-hmm.
So part of that is identifying who your ideal customer profile is, and you as the CEO and founder, building a script, and then hiring the right person who can begin to sell your product. So one of the kind of classics, I think, from a product person perspective, is I'm going to build a kick-ass product and people will just love it, right? And I don't have to sell it. But that's not the case. Like you always have to sell it. Now it can be an educational sales cycle that requires proposal and educating your client and the customer in some form of negotiation. And that's true if you're building an unknown product and selling it to a new market, or if the price point is high.
Mhm.
Or you can do a transactional sales process if it's a known market and their price point is low. Like if the price point's low enough, I'll put in my American Express card and just buy it, right? If it's a known product or a known market, like you're competing against something that I have an alternative to buy,
Mhm.
I can do that transactionally. So that's really marketing driven. And B2C is kind of the same way. So if I think of business to business versus business to consumer, the consumer offering has to be low enough that it feels like it's in the range of what I should be transacting, and I'll take the risk, right? I'll buy it. On the B2B side, if that's different because you're selling a higher price point for the most part. And the question there, am I buying an outcome versus buying a subscription? So what price point you play with is very important. So all of those variables turn around and impact, um, how much money can I actually begin to charge for this product? What will the customers pay for it? And in the early days, you're the CEO, founder, you're the one out selling it. But I have to build that script so I can hire somebody who can replace me, because you have other stuff you need to do too, like be the product evangelist and go talk to more customers and hire a dev team and do financial operations and find an interim CFO and talk to the CPA firm that they were talking about at the beginning of the sponsors. Big shout out to sponsors, because none of this stuff happens without them, right? So as a founder, you're really a generalist, right? Because you end up having to do all the stuff you can't hire to have done, right? So if I have to get a technical co-founder, I'm going to give them equity and some cash. But if I can't hire an accountant, I'm going to outsource to an accounting firm. If I don't have enough money to hire the salesperson, I have to do it. And a couple things you should know about hiring your first salesperson, that's worth noting, is salespeople are always good at hiring or selling themselves. And they're occasionally good at selling your product, which means you're probably going to have to fire a couple of them as you go, because and there's different profiles of salespeople, right? A salesperson who's maybe sold services is good at creating a proposal and understanding what the customer's needs are and negotiating a deal. Somebody who's used to selling a SKU and a product and a subscription will really struggle with that educational sales process. So, and the challenge there is you need to hire somebody that's already trained, because you don't have enough capacity to train them as well. So
Yeah.
lots of interesting challenges along the way. I always tell founders when you do a startup, there's 1,000 things that can kill you. And I can't keep you from doing all 1,000 things, but I can at least help you compress the time frame from 18 months to 6 months.
That's good. I think hiring and scaling the team is also another topic that we can actually talk. Have like a
Yeah,
series of
exactly.
workshop and a program to actually teach. But I think this is brings to another point where if you need to expand your team,
Mhm.
right, you need funding. Unless you have like a lot of revenue to have
Right.
enough cash flow
Which
to
is
fund
rare.
it.
Yeah.
Otherwise you need the funding, and what are the good point to kind of raise your the initial one. What would be the challenges the founders will be facing if this is like the first time they're trying to do it?
Oh, for sure. So I think the first thing is to know that your need for funding and your ability to raise funding are not correlated, right? So you need to be funding ready. And so there's a couple ways to do that, right? So the one is going out and doing the customer development interviews that you're talking about. And for folks who are new to this, customer development interviews are basically a structured interview process that allow you to go out and gather customer feedback and data. So I just did a program, Kenneth, overnight for Abu Dhabi. So I would normally have traveled there to do a boot camp, but since we're still in COVID lockdown, and one of the companies, their opening pitch deck was, we're dealing with engineering managers and building tools for engineering managers, was their opening slide. And slide 2 was, we've done over 175 customer development interviews that has told us that this is the right product to build. Now, their product is still super early and they don't have any revenue, but the fact that they had 175 customer development interviews is like, dang, that's amazing. Because as an investor, I have opinions. As a founder, you have opinions, but I have a checkbook, which means My opinions win. Now, if you have data and you've done 175 customer development interviews, I might let loose with that checkbook, right? Because it's no longer a question of like, oh, well, you have an opinion and I have an opinion. Like, you have data. So that's one thing you can go do, and it's totally in your control. And you can probably do it before you leave your day job. You can actually do that before you even build a minimum viable product. On the B2C side, I've done it the same way, where we wanted to go test a thesis. So we actually bought online ads in Facebook and Instagram, tested them to drive them to a landing page, using something simple like LaunchRock or it's a super easy tool. Put up the value proposition, put up the pricing, allowed customers to get to a point where they were going to go buy, and then threw them an error message that said, hey, we're sold out right now, or you're welcome to join our beta list. But I wanted to see what the click-through and closing rates were. So we tested the value proposition. We stood it up as if it was a real site. I didn't take anybody's credit cards, right? And founders are a little funny that way, because you're like, but you would disappoint somebody. I'm like, oh my God, it's an MVP. I'm going to disappoint people anyway, right? So I would rather know that people actually are looking for this product or service, and I can actually buy traffic at reasonable economics before I write a single line of code or build a specification, right? So if you think about it, there's a sequence to things that you can do that will save you money. And then there's a sequence to things you can do that are going to be super expensive. And I would encourage you not to do that sequence, like do the other sequence.
Yeah, exactly. A lot of the startup founders or the teams, they actually try to build a product before they figure out what the problem is, and before they actually find potential customers that has that problem, right? So they build a product and then they chase after and hope for to find the problem that
And there's a
that
little
they
bit
can
of
solve.
fear there, right? Like, oh, this idea is so good that if I tell somebody about it, somebody else will build it. And I think it's interesting because having started, Startup Week a few years ago, I was sitting on stage with somebody, and we were talking about, like, if we shared the same idea today on stage right now, and we both left here and built the same idea, it would end up looking very different, right? Because your life experience and my life experience are different. Our access to capital is different, right? Our ideal customer profiles. So even though there's this fear of like, oh, somebody's going to copy my idea, ideas die from a lack of exposure, not from an overexposure, right? So, and you really need to get out and talk with customers as fast as you can. And you may find out that somebody else has already built it, right? And that's one of the things that happens frequently. Or you'll find out somebody else tried to build it and they died, in which case you're like, I'm gonna research, am I whistling past the graveyard or not? Like, if everybody who's tried to do this has died as a company, like, I want to know that in advance too. So don't let that fear keep you from building the customer development interviews. And then with the customer development interviews, it will inform your decisions about, should I do this? And if I do, what are the features of the product going to look like? And then use that data to go talk to investors and say, hey, we've done 116 customer development interviews, and 100 of those 116 said they would buy it if we built it. And the answer is, wow, that's amazing, right? A very different value proposition for an investor.
That's good. So now we talk about quite a few things that we need to do after we come up with the business idea to kind of try to validate it and try to see if we have a business. Roughly how much time have passed, from the very beginning to where we've talked so far? Would
Probably
that
in
be
month
like
4.
4 months?
Yeah. So, because it's going to take you, if you're doing B2B, it's going to take you a couple months to schedule the interviews, but you can get 25 customer development interviews done. So at this point, we're starting to figure out, okay, the customer development interviews have informed our product features. We now have a spec written. We can get the MVP written. So we're going to spend that time to build the MVP and do a 2-week sprint. And then we're going to start to begin to tell our value proposition and story and build out a pitch deck.
Mm-hmm.
Right. So initially the pitch decks focus on the customers, but you're also building out a pitch deck to focus on the founders. So, or focus on the investors, like, is there investor appetite for that?
Mm-hmm.
So in that process, you're going to do the market research around who else has raised money in this market. How much money have they raised? How big is their team? Have they done any acquisitions? Were they acquired by somebody else? And all that data is available on Crunchbase, the free version. Or if you really want to splurge, you can spend $350 or $400 a year and buy the paid version, which I would encourage, by the way, if you get to that point that you're really looking for, investors because it'll give you who else is invested in this market that likes this vertical. With that, then you start to look at who are the investor profiles and what's kind of fundraising 101, right? So I think of this as stage appropriate capital, right? You can talk to an investor who writes an average check of $5 million because you're like, we would take a $5 million check. That's not the way it works, right? So they will take 20% of the company for a $5 million check. If you're not at that stage, they won't write you a check at all. Now, will they meet with you? If it's an interesting idea, maybe, which kind of gives false signal to founders, right? Because the founder walks out of the meeting, they're like, they loved me. They really liked me. Like, we can go back. I had a great meeting. And I would say as an experienced founder, my answer is it actually wasn't a good meeting. Like they got a little bit of education, but they patted you on the head and said, come back and see us when you have traction, whatever the hell traction is. And we can talk about PMF and traction here too. But the idea there is that investors take meetings early because that's what they get paid to do. But they don't invest in early stage unless there's signs of actual traction and product market fit. So investor preparation, you got to have the pitch deck ready. There's some blocking and tackling tasks you need to knock out. And like I said, the total tasks from that 4 to 6 months, you can do it. You could probably do it in 4 months, right? It may take you 6 months. If it takes you a year, you could still do it, right? But there's about 28, between 28 and 30 things you just got to get done. And the question is, the faster you compress them and getting them done, the faster you'll find out if this is a good idea or not. Or you can do it over 3 years and it's, death by 1,000 paper cuts.
Yeah, that's good. So with that, we move to preparing the funding. And usually, how long will it take for like the initial one, or like let's say a pre-seed or seed one? What should they expect? To take in terms of, because they will need to figure out how much runway or how much money they still have in the bank so that they can survive before they see the investor money in their bank, right? So what would be the, for the first time founders that are here that may
Chuckling
not want to
because
know?
when you're a first time founder, the answer is you're always out of money in the first pre-seed rounds, right? So you're gonna raise probably a $25,000, $50,000 check, and you need to compress that as fast as you can, but that can be a 3 to 6 month process because you're going out to meet investors and beginning to pitch them, and they're going to watch what you do, right? So they're not going to. I was talking with a friend a few years ago, and he's like, I went to an event and somebody wrote a check at a coffee, and I'm like, that never happens. And then I met the guy, and I'm a friend with him now who did that. And he's like, yeah, I did that a few times. Yeah, I created the urban legend. I'm like, would you do it again? He's like, oh my God, no. Like totally not, right? Because I want to watch your progress. Like you said you were going to go do these things in the next 30, 60 days. Did you not? So for the most part, that's an urban legend. If you happen to get one, send me a note. I'll retweet it because you're amazing, right? But for the most part, you're gonna come pitch an investor, and I'm gonna watch your progress. So one of the caveats here is, I would encourage you to pitch a plan that says, with or without your investment, we're gonna go hit these milestones, because that by its nature alone will put you in the top 10% of companies I talk to. Because most of the companies, the 90%, are like, well, I need your money before I can go do this thing. And I'm like, those founders don't get funded, right? Because I'm looking for the scrappy founder who's like, with or without you, we're going to go do this. Awesome. Like, go show me, right? And then I'm going to watch you 30, 60 days and see how you're doing. If you hit those milestones, right, and you start to see a little bit of traction, I'm going to be super curious as an investor, assuming I like your vertical market and the type of product and that sort of stuff. Most investors invest in where they've made money before.
Mm-hmm.
So if you brought me a pharma deal, I would look at it and say, that's super awesome. I hope you save cancer. My wife works in that industry. I don't really know anything about it. And since I don't know anything about it, I won't invest, even if it's a good deal, because I don't know how to judge the deal, right? So it could be a 3 to 6 month process, could be longer if you don't have any traction. And know in the early stage, you're going to set the pricing and the terms of a round that make it easy for me as an angel investor to write a check. That model flips when you go to institutional investors.
Mm-hmm.
Institutional investors are investing other people's money, right? As an angel, I invest my money. So I have to explain to my wife why I'm writing a check for this company. So if I can't repeat your message, that's a problem. As a VC, I'm investing other people's money. So I'm going to have a charter. And the charter basically says I invest in West Coast companies in technologies at the early stage. And if I invest in something other than that, my LPs, like the group of people who are hanging out here, my limited partners are gonna be like, dude, you wrote a check for $5 million and lost that money. Like, what the hell? So I don't invest outside of my charter, even if your deal is amazing, right? Because I have a charter. So you have to understand the difference between the investor profile and the investor stage. So that's stage appropriate capital. So you can expect that for the process. And if you're pre-revenue, pre-product, you can expect it's going to take longer because they're going to wait for you to have some revenue, some proof points, and have a product. The days of funding in the back of a napkin math or back of a napkin are, I would say, are pretty limited. You may still find, if you get lucky, that's awesome. I could probably go out and fund a company with the back of a napkin right now because I'm a 5-time founder and I've had 3 successes, right? But I'm not a franchise founder like Rich Barton, right? So I'm just a repeat founder. So each of those gets funded different based on the profile of the founder.
That's good. So once the founding team or the founders they got funding, assuming it's like the pre-seed or seed round, what should they do? Like, what should they do with the money? What will they do with the money usually in the in this early round? So they
Yeah.
for the first time founder they don't they don't know they expect they need money, but what do they do with the money now that they got some money?
Well, and you're usually kind of prepared for that. It's what's called the use of proceeds
Yeah.
is goes into the deck, and it's usually part of your financial model, and you'll get good at that too. But so your first real milestone, I always tell founders there's 2 epochs in startups, right? There's the world of kids pre-internet and post-internet. There's there's BC and AD. There's the world before Game of Thrones and after Game of Thrones. And your startup there's the world of pre-product market fit and post-product market fit. And product market fit is where you actually get traction and start to take off and show momentum. And by the way, product market fit isn't this obscure thing that, you can tell because it smells like pixie dust. Product market fit is just math, right? So we're spending money on marketing that's creating traffic. Traffic is creating leads. Leads are creating demos. Demos are creating customer calls and proposals, and those things are closing. And we're tracking the time to close. That's if you're B2B. If you're B2C, it could be users versus revenue. So we're gaining new users on a daily basis, and those users are referring other users. Whether you get to viral coefficient, what's called K factor or not, totally different. By the way, that's broken down in the 14 revenue models as well. It's called new media. So Snap is an example of new media that gets a viral coefficient. Mashable, if you remember that site, is an example of old media, not old like New York Times media, but the difference in revenue. So Mashable today, let's say they do $1 million in revenue, they're going to be worth $4 million. Snap does $1 million in revenue and it gets 24 times in trading value. So the difference between new media and old media is wildly different, right? So how you make money kind of matters in that. So if you're B2B, there's a path for you to follow in the math to do product market fit. And if you're B2C, there's math for you to follow and how you get a product market fit. But I was at an event last week that one of the VCs on the panel was like, well, they're soft signals. We'll know them when we see them. And I'm like, I disagree. I kindly, right? But I want to give founders the sense of like, no, it's actually really not, this mystical creature you're trying to find in the wilderness. It's math. So, and that may be the only thing I contribute to the startup world over the course of my lifetime, but that'll be a good one.
That's good. I think product market fit is such an important milestone that you need to hit before you can look and actually think about scaling. Because before you find it, you're scaling it. It's not going to be matter too much, or it doesn't really have the same effect. In a
Yeah.
sense, right?
Well, and a lot of the stuff that's written about product market fit is super valuable, but it's like when you have 1,000 customers, you can survey them and, if how disappointed would they be if they didn't use your product anymore? And it's like, well, that's great because you already have product market fit. But if you think about from the startup founder's perspective, it's like, what do I need to do to get to product market fit? Like after I have the luxury of product market fit, you can work on a bunch of things. Like I can survey 1,000 customers because I have 1,000 customers. Or honestly, you can work on your culture, right? Because before product market fit, you don't actually have a company. So should your culture be nailed down, you have all your vision, mission, and values down in advance. If you're one of those folks, I commend you, and that's amazing. But if you don't have product market fit, you may not have a company, you may have a nonprofit or a hobby, and you really need to get a product market fit, and you can fix everything else after that. Like people will be like, hey, can you help me recruit a board or understand how to run a board meeting? If you don't have product market fit, no, because it just doesn't matter, right? Do I need to know how to do? No. Like get to product market fit. That's the only milestone you need to hit. Everything else is like buying, what color file folder should I buy at Office Depot? Just doesn't
Doesn't
matter.
matter. Yeah, that's good. Now I want to be mindful of time and also let the audience start thinking about the questions that they want
Sure.
to ask, like, because we have 15 more minutes. So if you have questions, feel free to add it to the Q&A. And T, do we have anything on the Q&A yet?
Yes, we do. So one question is, do you have any favorite resources, books, blogs, article, etc., to help founders measure product market fit as described?
Yes, actually. And I don't have a chat window. So if you go to dkparker.com, you'll see information about the book. There's actually an excerpt, a free excerpt that you can get, that will pull the 14 revenue models. It's a downloadable excerpt from the book that you can get. So, and you can find the book on Amazon as well. But the product market fit definitions are there. I've walked through those resources in the book, and each of the revenue models, by the way, has slightly different key metrics, because if you're B2C, you have different key metrics than if you're a B2B enterprise. So just know that there's no one size fit all for key metrics. There are the language is the same, like LTV to CAC ratio and closing, time to close, but how you deploy it can be different. So.
Thanks for sharing. Another question was, you mentioned zombie startups who are
Mhm.
stuck and what that means for the investors. And what does pivoting mean and look like for an investor?
Great question. So a pivot is a change in strategy, either taking your existing product and going to a different market, or if you really like your total market, the market size you're going after, the question is going to a completely new product, or it could be both. We just went completely different. So I'll give you a couple examples. Slack was originally a gaming company, and their game wasn't very fun, but they built this amazing platform to communicate between players. So they went from a B2C gaming company to a B2B communications platform, which gave them some unique components around sharing, right? Because people would create ad hoc groups and to share because the tool was so easy to share. One of the other ones I really like was Odeo. And I don't know if you remember Odeo or not. So some of you are like, I've never heard of that one. Today we would call it Twitter. So Odeo and Jack and the team went back to Mike Maples, and there's a great story that Mike wrote in his blog called Thunder Chickens, that he wrote about it. And Jack and the team actually came back to all their investors and said, hey, we've got 70% of the cash we raised. We don't think this podcasting thing isn't going to work, which arguably you look back to pre-Twitter days and you're like, oh my God, podcasting at that point was so early, right? So they had some percentage of the capital they raised, like, we're just going to give you the money back. And Mike and some investors took the money back. Some investors said, nope, we believe in you. And that company went on to become Twitter. So that's an example of it, completely different product, completely different market. So, but those are the three variations of it. And I would distinguish a pivot different from an iteration. You're going to iterate all the time. Like your go-to-market strategy is going to change, how you do marketing is going to change, your pricing is going to change. But that doesn't mean you're going after a completely new market or that you have to build a completely new product. So know that all of those variations, a pivot revolves around, like, we used to make airplanes and now we sell tires. That's a pivot. It's a wholesale change of strategy.
Awesome. Then, what does that mean for investors who, for example, have a portfolio, a vertical, and if they pivot into a new industry, does that affect the funding or does it just stop?
Not really. I mean, as an investor, I've invested in you. And if you come back and say, but this is before you run out of money, right? If you come back and you're like, we did 50 customer development interviews and we found out and we launched the product and people weren't super excited about it. I've already invested in you and it's a sunk cost, right? So I'm like, what do you think you should do? Well, we think we should take this product and apply it to a new market. Great. Or we think we found this, as we did the customer development research, we found this other thing we think we should go do. Great. So am I going to be thrilled about it? No, like I wish you would have done that before you took my money, right? But sometimes that's not the case. So what I'm really after then is I don't want my money back, right? Because I've already deployed the capital. What I want to know is that do you have enough? Don't wait till you're out of money to come back and ask that question, because then you're like you're dead, right? And it's hard for me to refund. Not refund. It's hard for me to put additional capital after a company that's run out of cash. It's easier for me to say, oh, the team pivoted, they went and found this traction. Oh, I'm gonna double down on them. So keep in mind, as an investor, the thing that I care about is the team hitting the milestones that they outlined? I'm not setting milestones for you. You're setting milestones for yourself. So if you're hitting the milestones, I believe in you and I'm going to continue to invest for the most part. If you set big milestones and you never hit any of them, I'm going to be like, no, I can't, you know, because my investors are going to ask me, hey, why did you invest in Kenneth after he didn't hit the first milestones? I'm going to be like, I love Kenneth. He's amazing. And they're going to be like, that's a dumb idea. Like, that's not a reason to invest. Like, buy him a beer, like, be his friend. Right. But as an investment, we're trying to scale it based on the investment opportunity.
Awesome. Thanks for answering the question. I have another question here. It is, what would you suggest to show a customer as an MVP for a complex product such as an autonomous robot that would be difficult to hack together in 6 months or less?
Totally. So the question then becomes, how do you go out to the target? So think of this as, it's called an ICP, your ideal customer profile. So if your ideal customer profile is a car company, or your ideal customer profile is whoever you think that customer is, can you go out to them with a value proposition and say, we're building this complex thing. If we build it, would you become a customer? And you can do that in a couple of ways. You can do a non-binding letter of intent, right? Or you can do a proof of concept. It can be paid or free. So what I'm looking for is signal to noise, right? You're like, we're going to build this thing. It's going to be super awesome. Okay, go talk to the people who you think would be the customer and ask them, if you build it, would you do that? And would you give me a non-binding letter of intent? Again, it's non-binding, but what I'm looking for is signal. And if they come back and say, wow, you're the team to do it, you've got 3 PhDs, you've done this, you've done this theoretically here, but you have to have the team to do it, to pull it off, so that your customer would be like, if you can figure that out, that would be totally rad, right? So know that that's going to be the signal I'm looking for. Or you're faced with the dilemma of, how are you going to self-fund it to a point where you can prove out the equivalent of a minimum viable product, right? So you just have to keep stripping down the features until you're like, is it really minimum? And Reid Hoffman, the founder of LinkedIn, said if you wait until you're proud of the product, you've waited too long to ship the MVP, which is definitely the case, right? You're always going to be out early.
Thanks for answering. And I see one more question here. The question is, Canada, USA, advantages, disadvantages, fill in the blank.
Yeah, love them both. So, so we did a recent analysis on PitchBook data of funding based on region. And because I'm in Seattle, I use Seattle as a 100% benchmark, right? So what's the average seed round? What's the average A round, average B round, based on the geographies? So if I use Seattle as 100%, Silicon Valley is 187%, New York is about 147%, Vancouver is about 87%. Victoria is probably a little bit lower because there's no institutional capital in Victoria, and they literally live on an island, where the rest of us just feel like we live on an island from a funding perspective. But MENA is 22% and Kansas City is 77%. So where you are matters from a geography standpoint. But the good news is now post-COVID, you can do a video meeting with somebody in Silicon Valley super easy. So in their view, they're getting a better buy, right? I'm getting a discount by buying in Canada. But recognize that we all have, every market I've been in, we all have a chip on our shoulder, right? Seattle compares itself to Silicon Valley, and Portland compares itself to Seattle, right? And we're always like, oh, we don't have all the things that you guys have, which is true. But we never look backwards and say, oh, how do we help Portland or help Vancouver, right? Which is like, so I look at Vancouver as a great place to find deal flow as an institutional investor, because it has fewer institutional investors. Victoria is the same way. Right. I think that generally speaking, however, VCs are lazy. right? So it used to be like, oh, I'm not going to invest anywhere that I can't drive my Tesla to the board meeting for, which means why Silicon Valley has so much density. I still think that's true, right? But should you move? I don't think place matters as much as it used to. So one of the things we're working on I work with the Washington Technology Industry Association, and we're working on the Cascadia Council as well about how do we improve that for the region, because great entrepreneurs are everywhere. Access to capital is not everywhere. So that's a challenge. That's a long answer to your short question. How's that?
Great. Thanks for answering all the questions. That's all the questions I have from our audience on Hoova and our Q&A. But yeah, thank you so much. I learned a lot in this session, and thank you Startup Grind Richmond. And for the attendees for joining the session, I also want to take this time to invite everyone to check out other sessions, connect with others on the community board, check out Sponsor Booth, and also the Career Fair. And thank you again. I hope you've been enjoying Vancouver Startup.
Can I end on one thought? One
Yeah.
thought for you all. So you'll find that if you reach out to me, I'm happy to reach out, and you'll find my calendar block sign up is in the bottom of my email signature. My one request is this: I will ask you the question of who are you mentoring that doesn't look like you. If your answer is, oh, it's so and so, I'm happy to schedule time and be a coach and be a mentor. But if your answer is, I'm not mentoring anybody yet, then there's always somebody who's a chapter in the book behind you, right? You're good at product, they're good at marketing, you're good at sales, they're good at finance, right? But I would encourage you as a community, the one thing that we've been working on in Seattle is we recognize that we're not Silicon Valley, right? And Silicon Valley has this rare thing called recycled capital. And the reason they have recycled capital is Kenneth and I worked together when we were at PayPal and part of the PayPal mafia. And now he's doing a new company and I can reinvest in him. But that creating those relationships is intentional, and it involves giving back to the community. Even when you're building your startup, you have a little bit of time you can give back. So know that you're part of a community that's bigger than you, and that community has all the weird uncles like you would have at Thanksgiving anyway. And nobody owns the community, and you can't exile them. You just have to get along with them. So I'm happy to be a mentor and a coach along the way, but just know that's my requirement is I'm going to ask you if who you're mentoring that doesn't look like you.
I think that's great. I think that's actually a very good advice, especially for Vancouver being I'll say it's still a growing ecosystem. We still need a lot of improvement before we can go to the next level. And one thing that is very important is the mentoring, right? People that has experience in certain area, they can teach and also mentor the others that doesn't really have that experience or level yet, that we can kind of get everyone above whatever we had, and everyone will be improving, and that will help a lot of startups that way as well, right? So that's very good advice, and thank you, Dave, again for sharing your experience with us. Looking forward to talk to you again next time.